gold would have to rise roughly 6x just to get back to the long-term 50, 60-year average of where it traded in that ratio. And if we, like I said, if we had an honest-to-goodness dollar crisis, gold would have to go up 19x to match the price level it was at in 1980 relative to foreign-held treasuries outstanding, which just gives you a sense of exactly how exaggerated the growth in U.S. debt has been and how subdued the price of gold has been since those periods of time. Gold is doing what it's doing because gold is taking the place of treasury bonds as a primary reserve asset globally at the central bank level.
The question that's on everyone's mind is how long foreign investors will continue to support the U.S. Treasury debt that has now ballooned to $34.75 trillion and will nail $35 trillion over the next few months. These securities are all held by someone, and a portion of them are held by foreign entities. The U.S. Treasury market has been losing its share as a primary global reserve asset since 2014 because global central banks have sold $400 billion worth of treasuries on the net and bought $600 billion worth of gold on the net. After BRICS, Japan is now dumping U.S. bonds and mitigating the losses it incurred from adverse interest rate bets. The latest data shows Japan has offloaded $63 billion worth of U.S. and European sovereign bonds by March 2024. U.S. Treasuries will be dumped as global reserves by 2030 as the U.S. dollar gets repriced from widely overvalued levels, triggering 3x returns in gold, according to Luke Gromen, founder and president of Forest for the Trees. Macroeconomic pressures and geopolitical tensions are leading central banks to stock up on gold. The World Gold Council reported that last year, central banks added 1,037 tons to their portfolios, second only to the record of 1,082 tons set in 2022. And the interest in the precious metal continues. The Council's 2024 Central Bank Gold Reserve Survey, which included 70 central banks, found that their sentiment towards gold remains very high, with 29% indicating they will add more gold in the next 12 months, and 81% stating that official sector gold reserves overall will grow during the same period. Before we explore further, be sure to subscribe and click the bell to stay tuned for more engaging content.
I think the reason why the U.S. Treasury market is losing its share as primary global reserve asset, and we can see that since 2014, global central banks have sold $400 billion of treasuries on net, and they've bought $600 billion worth of gold on net. So from a marginal perspective, for the last 10 years, central banks have bought gold and sold treasuries. The reason I think this is happening is multiple. Number one, for the reasons I just highlighted, some of it's mechanical. When the dollar gets too strong, you sell what you can to raise dollars, not what you want to. That's treasuries. Number two, some of it is geopolitical. Treasuries for central banks are no longer risk-free instruments. If you do something the United States government doesn't like, they will take your treasuries, full stop. They've done it to Russia. They've done it to others. And that has opened eyes. The third point is a little more subtle, but it is in a world where you have peak cheap oil, which is to say we're not running out of oil, but we're running out of cheap oil. It costs more and more to find marginal barrels of oil. When we're in a peak cheap copper world, where, again, we're not running out of copper, but the copper we find, the prospective supplies are much, much higher, and everyone wants to electrify everything, then you can't store the reserves that you're going to need to, at some point as a nation, deploy possibly into oil, into copper, into commodities. You can't store that in bonds. You need to store that in a reserve asset whose value either stays flat or gains versus oil and copper. And gold has a very long history of maintaining or increasing its value in oil, copper, and other commodity terms. For example, in the last 15 years, oil or gold is up roughly 4x, about 3x to 4x versus oil, and a little over 4x against the Goldman Sachs Commodity Index. And in contrast, treasury bonds are certificates of confiscation against commodities in a peak cheap copper, peak cheap oil world. Now, if the U.S. debt load was modest, such that the Fed could credibly say we will raise rates as high as we need to in order to contain inflation and keep treasury bonds as good as gold for oil and for commodities, then we wouldn't be seeing this switch, in my view. But the problem is, with the debt at 120% to GDP and deficits at 7% with near or full employment, the United States cannot credibly say we're going to raise rates as much as we need to stop inflation. They can't. The United States government can't afford much over 5 or 6% on the 10-year. We know that. We saw it last fall. So if you've got a bond that can only raise rates so much in a world where the geology of copper and the geology of oil and global growth in the global south suggests that the prices of those things are probably going to go up pretty notably over time, then you better store more of your surpluses, more of your central bank FX reserves in a reserve asset, number one, that the Americans can't take, which is gold in your vault, not treasuries, and number two, that preserves your country's purchasing power in oil and copper and commodity terms, which is also gold, not treasuries.
After gold, oil is posing challenges for U.S. Treasuries. Luke Gromen emphasizes that the increasing gold-to-oil ratio holds profound implications. Currently hovering between 30 and 31, this ratio historically indicates a critical turning point. Gold has surged to record highs driven by robust demand from central banks and investors seeking a safe haven amidst escalating geopolitical tensions. Although oil prices haven't yet reached the symbolic $100 mark, concerns over the Gaza conflict, production reductions, and heightened summer demand have propelled Brent crude to 7-week highs. Crude oil has climbed approximately 12% since the beginning of the year. Numerous investment banks and financial experts are optimistic about continued gains in both gold and oil. Analysts anticipate oil prices will maintain stability around the $80 mark in the near term, further underpinning market expectations. Gromen's analysis underscores the evolving role of gold as it displaces Treasury bonds in global central bank reserves, a trend likely to drive gold prices higher over time as it assumes a critical role in the global financial system. Now, let's delve into the video.
So historically, gold to oil ratio, a low gold to oil ratio is a healthy, that's a dominant treasury market as primary global reserve asset, because you've got a low price of gold, which means gold is not competing with treasuries as a reserve asset. And you've got a relatively high price of oil, which means there's a lot of petrodollar surpluses being thrown off, flowing into US dollar denominated assets, treasury bonds. So low gold to oil ratios, that's a dominant treasury as primary global reserve asset. Flip it over, high gold to oil ratio means rising high gold price, lot more competition for treasury bonds as a reserve asset, and or relatively low oil price. And in a relatively low oil price, there's either not a lot of petrodollar surpluses being thrown off to be recycled into treasuries, or worse yet, it's too low and the price of oil is too low, and OPEC plus, et cetera, have to be redeploying their treasuries, selling treasuries to smooth over current account deficits to, fund social programs over there to prevent political instability. So that's why the gold to oil ratio, I think, rising is conveying a really important message, which is, it's at a key level here. It's at 30 or 31. And like almost everybody thinks, okay, well, it's been at 31 before and it rolls over. Except basically every single thing in macro is telling you it's going to keep going higher. You're seeing the BRICS recycle into gold. You're seeing Yellen throw 40 years of economic orthodoxy in the trash. You're seeing the Fed say we're not going to let treasury auctions, treasury market dysfunction. We will add liquidity whenever it's needed. So I think ultimately, again, nobody trusts the Chinese. And even if they did, China doesn't want to open their capital account and issue debt. They don't want the system the Americans had from 1971 to present. They want to use gold. No one trusts the Russians. They will want gold. The Japanese don't want it, even if they could. They're not big enough. Gold. The Europeans don't want it, even if they could. Gold. So gold is doing what it's doing because gold is taking the place of treasury bonds as a primary reserve asset globally at the central bank level. And as that happens, that's a whole lot of buying against a gold market whose annual production is 240 billion. Look, the oil market globally is like 13 times that annually in physical production terms. That's just the oil market. So if you want to start fitting commodity surpluses into gold, the price of gold is going to have to get a lot higher. And so I think the gold to oil ratio is going to go a lot higher over time.
Foreign investors have continued to add to their holdings of Treasury securities over the years, but the U.S. debt has grown far faster, and so the share of the debt that is held by foreign entities has been declining for many years. From 2014 to 2016, foreign investors held over 33% of the debt. Their share is now down to 22.9%. Will gold replace U.S. Treasuries as a global reserve asset? Your opinion matters. Drop your thoughts in the comments, hit the like button if you enjoyed this, and subscribe to stay informed on our journey together.